Hey everybody, thanks for coming.
Jeff, I'm sorry, you're live.
All right. Hey everybody, hope you're doing well. Thank you for coming. Thanks for attending the event today. It's good to see you. If you're watching the event in the future, make sure to hit like and subscribe. It helps a great deal. We appreciate it. We will have special prizes today. So Ray's going to ask a number of questions, and we have 5 prizes. So I encourage you to interact. Answer them. Basically, if you're in GoToWebinar, there's a questions box or a questions button off to the right. If you click on that, that'll allow you to answer a question, and if you give the right answer, you'll qualify for a prize. So if you're in YouTube chat, just throw the answer in YouTube chat. I encourage you to interact. All right, very cool. Let's go ahead. Let me read a legal disclaimer. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features with that in the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor is it paid for the promotion of a security. No information contained in this presentation should be construed as investment advice or the solicitation to buy a security. So there you go. Our guest today is Ray Rondeau. Ray's a good friend of Metastock. We've known him for a number of years. A prolific systems designer. He's been doing it for a number of years. He works for the American Association of Individual Investors, AAII.com. He does a lot of education with them, a lot of system designs. He's a technical analyst. He's a developer and programmer for Metastock and another program. He's performed over more than 200 different events, academic and investing type of events. So without further ado, let's go ahead and get you started, Ray. How are you doing today?
I am good, and I am going to share my webcam. How are we doing?
Right. I'm going to pop that notice over there so you can share your screen too. You look good today.
Great.
Hello, good to see you.
I try to always look the same. Let's see if are we on the right one, Jeff?
Yeah, it was. Yeah, that's. I can see exactly what. I can see your bio, basically. Epic.
Great. All right, then we're all set. You're going to hand it over to me, and we're ready to go?
I'll get out of the way. It's your turn.
Okay, here we go. That's my bio, which is not really exciting, but hopefully everything else that we have today is. So welcome to today's presentation, How to Improve Investment Performance. As referenced in the promotion for this event, we're going to kind of take a so you think you know investing, you think you know trading, but you're going to have to prove it to us. It's kind of a fun approach. We have a little bit of investing humor, some content related investing quotes, and a few interactive segments where you can win a free education class. And I just actually did this presentation yesterday, and there were over 600 people in the room, so they didn't have as good of a chance as you're going to have to win a class. Again, I want to make one thing clear. My background's in engineering and mathematics, but I was a trader for over 2 decades before officially joining AAII in 2022. So if I'm using the words investing or invested today, it's applicable to trading and traders, right? An extension from a trader to an investor is a very easy transition, not so much the other way around. To win, as Jeff mentioned, simply be the first person to correct the answer in the questions area. When we come to a quiz, I'll ask you the question, just type in the answer. You can only win once, and you only get one guess per question. Jeff will be the judge, jury, and executioner. And what you'll win is any class from our video education suite library. And I'm going to talk a little bit about that. I've been doing investment education presentations for 24 years now, and I always start and end with a quote. Benjamin Franklin once stated, and everyone knows this quote, "An investment in knowledge pays the best interest," which plays on the double entendre best interest. For our purpose, it's investing interest. The primary theme of this presentation is the importance of investment education and how it can make such a dramatic difference in the quality of your life and of your loved ones. And because of this, we're actually going to have an offer to give one of your loved ones the EI course for free, and it's a great holiday gift. And all of this centers around AAI's newest educational offering, AAI's Essential Investing course. And although I'm going to tell you about the course over the next 3 or 4 slides, after that, 98% of this presentation is about the actual content in the course and about trading and investing. I am going to tell you a little about the course, and here it is. The course currently has 17 classes and over 12 hours of material. The classes in the course are not simple recordings of a single instructor standing in front of a camera or repackaging of a webinar or some live event like so many educational products. The classes are professionally produced. They are full-featured, interactive, multi-camera, studio-grade, audio-engineered recordings with a focus on essential investing and trading principles and strategies. The course is housed in a professional learning management system, the gold standard for online learning, a big expense to us. The course contains dozens of instruction and navigational documents and videos if you have any questions. The course includes an exam, and if passed, EI course certified participants will receive a certificate of completion and an extensive list of AAII EI course certification benefits. The primary education content, the videos are full-featured scorum. They have jump to table of contents. You can keyword search and jump anywhere in there. They have self-assessed quizzes. There's interactive hyperlinks to take you to external content. Excuse me, and they're closed caption compliant. This video shows you what's in each individual class, and I'm just going to go through this just to kind of give you an idea of what's in there. We start with a snapshot tab. Each class is the same, gives you some preliminary information, the number of credits, the focus of it. The second tab tells you about the instructors, gives you contact information, shows you some resources and articles by that person. Then we have some preliminary learning documents. We give you keywords and definitions you may want to know before starting the class. We give you all the slides. And we also give you some preliminary learning readings that the instructor recommends that you become familiar with before jumping into the main class. Of course, the main class is a video. It's interactive with the parameters, some of the parameters that I just told you. When you finish the class, you have to pass a test. We give you unlimited attempts to pass the test. And when you do, it will then unlock bonus videos, words of wisdom segment, and it'll also give you a bonus, which will give you usually a free book or some type of free offering from each instructor. Once you finish there, well, you also get your certificate of completion for each class, and then you'll get one for the course. After you finish that, we give you tons of resources. Sometimes these are tools, sometimes these are articles, sometimes they're spreadsheets or worksheets. We have a survey where you can rate the class, and we also have a discussion forum area so you can converse and ask questions with other people taking the class, and a help section. So that's what happens on each class. Now, all these features and benefits, again, are in addition to the EI course benefits. We give you a full year to complete the EI course, and it even includes a 60-day money-back guarantee. It's really an incredible course, and there's nothing on the market like it. And I know because it took us literally 5 years to put this together, and I'm not kidding you. The EI course is not static. We'll be releasing more already recorded classes in the future. Many of these people you will know. People coming up, a Systems and Forecasts and MACD fame, Marvin Appel, Fidelity's Denise Chisholm, one of my favorite analysts. We have Louis Navalier on how to pick winning stocks. You've probably seen, we have Christine Benz from Morningstar. We have Ken Fisher, who did a brilliant segment from one of his mansions in front of a roaring fireplace. We also have Marty Fritzen on fixed income investing. If you don't know who Marty is, he's on the board of the CFA, New York Society of Security Analysis. He was the chief high yield strategist at Merrill Lynch, head of corporate bond research at Morgan Stanley, and the youngest person ever inducted into Fixed Income Hall of Fame. The point is that it's really rare to be able to learn from these type of people, get tested, and then get a certificate of completion. If you're interested, you can go to www.aai.com/affiliate/metastock/Holiday for more information. And hopefully, Jeff, you can post the link. We've partnered with Metastock. We love Metastock. And you can get, like I said, We have a special BOGO offer, and we'll also give you a free class. So you can go there for that. I'll tell you more about that at the end. This is a perfect segue to the 3 investment areas that we're going to look at today, and I'm done talking about the course. Okay, it's based on material from the Building Wealth Through Investing classes in the course. And the goal here is see if we can make a positive difference in everyone's life. We'll say over the next 35 minutes or so, and I'm pretty sure that we can. How do we improve investment or trading returns? Of course, this is somewhat assumes or implies that you're already investing and you're already trading, which is not always the case. So to start, our basic questions that we're going to ask are, why should I invest or trade? Can I be successful? What does it take to be successful? And how do I put myself in the best position to maximize or improve performance? And we're going to start with a story. It's a true story, but the underlying concepts of this story are not necessarily novel. For years, I had been part of and oversaw an advanced group of investors and really traders that met regularly at MIT, in Cambridge, in Boston. And as you can imagine, it was a competitive environment, and we like to encourage and challenge each other. So about 20 years ago, and it was that long ago, actually a little longer, we had a graduating student propose a challenge to the group. We'll refer to him as Shane, as we kind of changed his name to protect the innocent. But Shane was going to become a dad, and he wanted this following for his son. He wanted to legacy $1 million to his son at his son's retirement. That's important. It's his son's retirement. He wanted to do this either through investing or trading. He had no money to invest or trade with. He didn't want to do any additional work or effort, which made it a little more difficult. And he wanted to live the same lifestyle with absolutely no sacrifices. Now, obviously, Shane was being slightly facetious here with the desire to bequeath $1 million with nothing to invest or trade and with little or no effort. But it makes an interesting challenge and subsequently a valuable study that leads to a number of important investment-related ideas that we're going to call revelations. So after debate and deliberations, we had to agree on a theoretical compromise. We needed some money to start the investment process, so we looked and settled at $2.76 a day. I'll tell you about that in a minute, why we came with that number. And basically, it was the prices of two bottles of water. There was a debate going on about that at the time. So less than $20 a week. Now, 2 things here, right? This is not a new concept. And I know that we said Shane did not want to sacrifice anything, and he's not going to. We're going to remedy that as we go on. So here's the proposal. We propose that Shane will invest $83 a month, only for the first 18 years of his son's life. How much money would Shane have to bequeath his son? Well, if you can answer that question, you should be doing the webinar, because we're missing one key ingredient, right? And what are we missing? We're missing the anticipated percentage return on the investment or his trading. And that's really what this presentation is about. In this table, we have some statistics on historical percentage returns of US stocks and various asset classes from Paul Merriman, who does an excellent presentation in one of the VES classes. Now, we didn't take Paul's findings of 14.4% on small cap value. We could have, but we just went with a nice round middle of the road historical average number of 11%. With a long-term time horizon of 70 years, 100% equity exposure seemed reasonable throughout most of that duration. So now here's your first quiz. Here's the question again. What do you think? How much money would Shane accumulate after investing $1,000 per year with a return of 11% after 18 years? I'll give you a second to type in an answer. Well, get ready to be disappointed. After the first 18 years, the final balance with the $18,000 worth of contributions was only $53,000, $53,137. Not very good, is it? But before you turn off your computer, according to the plan, Shane does not add another penny and simply lets it ride. Here's your second quiz. So now, how much would Shane have to bequeath his son, presumably in a trust, when his son turns 70? And the winner, Jeff, will be whoever comes closest to the exact dollar amount, but without going over, okay? We don't want a Price is Right type of thing. So you can't go over. Give you a chance. He puts $18,000 in over 18 years, doesn't do another thing at 11%. Okay, so what was the goal? The goal was $1 million. Believe it or not, it comes out to over $12 million, $12,083 at Shane's son retirement, all for sacrificing a couple of bottles of water each day and just for the first 18 years of Shane's life. Now, of course, this is purely hypothetical, right? We're assuming historical returns, which is all we have to base an assumption on. But we're leaving out some major factors here. Commissions and fees, they're kind of becoming a thing of the past. Slippage, this is an underrated loss that I'm going to cover in the next section, showing traders how to deal with this. Taxes are not minimum, but there's strategies in the course, at least, by AAI's Charles Roplot, who addresses that. And inflation will significantly reduce this value, but come on, $12 million is $12 million. So after several months of meetings on this, there were several repeated lessons or revelations that kept coming up for building long-term wealth through investing and or trading. These were from the group's experiences in their rather extensive research on this topic in strategy design. There was an estimated 700 plus years of combined knowledge from a high-profile group of full-time investors, professional traders like yourselves, and educators on trading and investing. And in the remaining part of this section, we're going to look at a portion of these 16 revelations for creating wealth through investing and or trading. The first one you probably know, revelation number 1, have a plan. Without a thorough, reasonable, and attainable plan, it was believed that investors and traders would be more likely to achieve their goals and get to where they wanted to go. It seemed that successful investors and traders had a plan, and with a plan, it reduced the tendency to act emotionally and subsequently chase returns buying high and liquidating investments during major sell-offs or selling low. It was believed that investors and traders who had a plan seemed to stay focused and in wise mind, where they clearly made better decisions. Revelation number 2. Excuse me. An investor had to accept that variables and uncertainties in the markets exist and that no plan is perfect. I agree. We don't know what the future historical stock market returns are going to be or what your trading returns are going to be. But to design a strategy, we have to make assumptions and projections based on the best information that we have. We want to control what we can and accept what we can't. And I think most would agree that having an investment plan or a trading plan that is not perfect or foolproof, seldom things are in life, is better than having no plan at all. Revelation 3, there was no single best plan or strategy for every person in every situation. The belief here was that an individual's ultimate approach in their selected best investment or trading strategies had to be based on and in line with their own personal situation and their strengths and weaknesses, some of these which you see listed here. And even then, an investor and trader had to realize that those would change throughout one's lifetime, and they needed education, the educational foundation, to adjust them components appropriately. Put another way, the right way to invest or trade is always the way that's right for you. It's not universal. Revelation number 4, don't be afraid to think out of the box with alternate solutions. In Shane's case, everyone came up with a different way to invest and came up with different ways to accumulate the funds to invest. Remember, Shane had no money. Part of the reason this challenge started was a debate over bottled water, as people at MIT will debate over anything. With that group, most people's big life change was purchasing a $150 water distillation unit or home water filtration system, as opposed to spending $1.50 for filtered water from some big city public municipal water supply. And that's what the two biggest suppliers in the US do. They reasoned it was cheaper, they didn't have to lug it, and it was better for the environment and better for their finances. But Shane thought out of the box, or the bottle in this case. His solution choice was, instead of paying cash or using a debit card for regular purchases, he started using a credit card with a 2% reward for all of his purchases. And the card he chose automatically transferred the rewards directly into his brokerage account. And these cards still exist today. And at the end of this section, I'm going to show you how Shane expands this to attain 7% risk-free, essentially creating money out of thin air. But for now, at 2%, and with this approach, he had no change in lifestyle, and it did not require any additional effort meeting the criteria. At the time of this study, U.S. budget statistics showed expenses for the average family were around $53,000. This was more than enough to get him to his target of $2.76 a day. But the key word here is directly. This strategy directly transferred the money. Revelation number 5, voted on as the second most important aspect of being a successful investor or trader: discipline. For this strategy to be effective, Shane had to actually invest the reward money and pay the credit card each month in full, perhaps. The best investment plans and strategies in the world won't work if an investor or trader doesn't follow them. In fact, it's routinely found in hindsight that the reason that most investors and traders fail is not because of the strategy, but because the person failed to follow the strategy. In fact, the 2022 study by Dalbaz showed that over the previous 30-year period, the S&P 500 average return was 9.65%. You can see it right here. While the average equity mutual fund investors' return was only 6.81%. Now, there are probably many reasons for this, but certainly one of them could be that emotions cause many investors, presumably without a plan, to chase price and uptrends and then panic in downtrends. Revelation number 6, good investors and traders certainly don't fear technology. And for those that don't want to use it directly, they're open to using the information derived from it to their advantages. On this video, you can see me running a back test on kinetic conviction starting on May 8th, 2023. This is the day we released this strategy with Metastock, and this is run through September. This was from my November lecture. During this period, the strategy had a hit rate of 87.5%, a profit factor of 10.85. That won't last. That was because the market was going straight up. It's more likely to be around 4 to 1. And it had a non-compounded return of 3.42% every 22 days. Consecutive wins was 13, and it never lost more than once in a row. Now, using technology for testing factors and developing technical-based investment strategies is important. By using programs like this with Metastock, we can generate hundreds of fields of information on hundreds of stocks over decades when testing a theory. Then we can use the program to optimize the individual factors and then synergize multiple factors to create a trading system or investment strategy. Now, is this foolproof? No, it isn't. And is this easy? No. Often it takes hundreds, if not thousands, of lines of code and weeks to develop a good system like you see here. But research like this is invaluable, and it's the only true way to design a system. Some good news, though, kind of countering this. Revelation 7. The group as a whole believe that investing plans and strategies, once they're developed, did not have to be complex or to be effective. And here I can state chart reading has a definite law of diminishing returns. The truth is that an investor can gain a large percentage of the benefit of chart reading while only knowing a small percentage of the technical theory. And this is true for trading too. After decades, I look for the same setups over and over because I know the probabilities because I back tested them. For the normal investor, maybe 4 or 5 key patterns, 2 or 3 indicators is most investors will ever need to know, and these are all covered throughout the course. Here's a couple of examples of some simple strategies for mutual fund investors, just to kind of get us warmed up. And I would assume, even as a trader, we all own some funds in our 401k or retirement accounts. In this table, we can see the results from a study published in Stocks and Commodities magazine in 2023 on the average returns on each day of the week of the S&P 500 from 1965 through June 2023. And as replicated by many, they showed that Mondays were the worst performing day of the week. with an accumulated average yearly return of a shocking minus 1.75%. And it only gets worse for small caps, with the Russell 2000 coming in at minus 2.19% as measured from the year 2000. I mean, look at that differential. Now, traders would know this, and we use this to our advantage, but mutual fund investors could also use this. How? Well, they could time their periodic weekly purchases on a Monday, presumably getting lower entry prices. Another reasonable approach might be, after a major sell-off in the previous week, to consider refraining from reviewing your account on the weekend, getting sticker shock, kind of panicking out, and then entering fund redemption orders. These orders would be filled at Monday's close, which are historically lower prices, especially in this situation. There are reasons that Mondays are lower. At least according to the statistics, you'd be better off waiting for turnaround Tuesday and getting probable higher prices if you still want it out. Here's another one. It's been believed and it's been measured that the last days of the month and the first day of the month are the best performing days. The Journal of Wealth Management published a study reinforcing this phenomenon. So for those who dollar cost average for purchases into mutual funds on a monthly basis, perhaps they should consider not transacting at this time like most investors. Their research suggested purchasing on the 23rd of each month and doing periodic redemptions on the 1st when prices tended to be higher. Revelation 8, intellectual-based investment research approaches and strategies seem to be more effective, as I just showed you with the back testing. This is a pillar of AAII, evidence-backed research. We just touched on this. I don't want to hear somebody tell you or tell me, well, this is based on my 20 years of experience. I need to see hard data. I need to see this tested over 10,000 times. So here it was believed that for no other reason, if an investor believes in and understands the strategy and there's evidence supporting the strategy's effectiveness, they're more likely to follow it and stick with it. They realize drawdowns are going to happen and they have a scope at least of the potential of the drawdowns. In our course, Wayne Thorpe has 3 classes on stock investing, and one of those classes focuses on important factors when using a fundamental stock investing approach. In fact, one fundamental stock factor or measurement was so relevant, I don't know if you know this, that the co-authors of the paper won a Nobel Prize, Farmer and French. As they showed in a study from 1963 to 1990, that stocks with the lowest price to book value ratio, right here, outperformed stocks with the highest by over 13% per year. It's this type of research and these types of factors and why we use Metastock to develop systems. And it's also what we base AAI's fundamental stock screens on. Revelation 9, when considering any investment strategy, it's good for an investor to be skeptical and to be sure what they're looking at is accurate and realistic. This is one that I think is important and many traders don't gravitate to. There are many potential problems with backtesting, interpreting investment news, statistics, and strategies. Numbers can easily be manipulated. Look for yourself. I want to give you some suggestions here. Ask yourself if the strategy results were generated across both good and bad market environments. Look for detailed backtested results over long periods of time on hundreds of stocks. Don't show me one stock or 10 stocks. You could be cherry picking. Anybody can do that and make any system look good. See if the results have been accurately reproduced by an independent third party and make sure they're certified and their reputation is locked in on them. That's why AI is partnered with Metastock, right? We're not going to focus too much on some of the products that we have with Metastock, but one of that we do have is called Kinetic Conviction. It's featured in the course. We have 2 classes on it, and you can see right here the results. Now, this is over 10 years, right when we brought the product to Metastock, and you can see it had nearly an 82% hit ratio with a 3.73 profit factor. This is on 500 stocks over 10 years, and it never lost more than twice in a row. And these results are actually better than what I'm showing you there. And if you question this, we have some webinars with Metastock that I'm sure Jeff can tell you about to show you that. This is the computer-generated back-tested realized equity curve for the kinetic conviction profit factor system with Metastock. And by the way, it's only with Metastock. This shows, again, every stock in the S&P 500. It worked over good and bad market periods. It didn't even seem to flinch during the COVID drop. Metastock has archived webinars on this system in the entire conviction series. You can get them by contacting me or I'm sure Jeff. We have instruction manuals and full performance reports showing the system parameters, hit ratios, projected returns, transaction, entry and exit efficiencies, drawdowns in every single trade, literally over hundreds of pages. And again, you can get these either from Jeff or myself. And yes, we had all three of our technical-based system performance reports and results certified by an independent third-party company called QuantKey. Revelation 10, even with the best of intentions and exemplary research and testing, investing strategies are still about probabilities. They're not about guarantees. Successful investors accept that strategies, approaches, and methodologies are what they are. They're not infallible. No matter how many things line up as a trader, you know this. There's never a guarantee the approach can still fail. We just accept it. And that's why we use risk-controlled techniques, and you knew that was coming. Revelation 11, sound investing strategies focus on risk first. Buffett's 2 rules of investing, right? Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now with that though, remember I'm a trader. I'm going to throw you a curveball here. And although there's a definite correlation between return and perceived risk, this is a fundamental principle of finance in the investing world. There has to be a point of balance. And this is why many of us become traders. Because I'm going to now try to get you to consider higher returning investment types or more aggressive approaches if your system performs it. Revelation 12, before we get to that, although it may not be the 8th wonder of the world, and Einstein did not at least originally state it, compound interest is an extremely beneficial force for investors and traders, with even a greater effect than we anticipate, as we saw with our example with Shane, 18,000 to 12 million. 2 well-known rules on compound interest. Number 1, the more frequent the compounding, the greater the effect. Banks use this against us. And number 2, the longer the time period, the larger the compounding effect. Which leads us to Revelation 13. Start early, and investing something is better than investing nothing. For the start early, look here at the halfway point after the first 18 years of contribution at year 26, okay, with our example with Shane. He only accumulated a profit of $748,000. It was in the next 26 years that Shane accumulated $11.28 million more profit. Unfortunately, many younger investors don't want to hear or accept this revelation, but they need to. That's why we're offering a free EI course for a loved one, which very likely will be somebody who's younger in your life and you're trying to get involved in investing and trading. It's critical to get people to start early. Revelation 14 is something that many older investors don't want to hear. Revelation 14 is a few percentage points more of return can make a big difference in the outcome tie into being a trader. In this table, we see that a 5% return with the parameters of our example with Shane only give you a final balance of $363,000. But an 11% return, that's where we get Shane to his $12 million plus. Dramatic pause. Expanding on this, and this is a critical slide, percentage return differences are not linear. Many people do not realize this. This is important. A 3% increase, say from 2% to 5%, only nets an additional $303,000. And this questions the strategy of reaching for yield at so-called safe target amounts where many older investors want to be. This creates a supply-demand imbalance. I'm a member of the National Association of Active Investment Managers, and I hear this a lot. I want to make as much money as I can, but I don't want to lose. Well, that's a crowded trade, right? But we can see now the same 3% difference from, we'll say 11 to 14% nets you an additional $54 million with the parameters of the example with Shane. This reinforces the case for either becoming a trader or for higher small cap equity portfolio weightings if you have a longer time horizon and your situation supports it. A foundation of AAII. If you recall earlier from the research by Paul Merriman, he showed that small cap value stocks returned 14.4% over his 90+ year research period. Right there, 2 to 5, 11 to 8. Look at that dramatic difference. Leading to our final revelation in this section, and we're going to give you a free class on this one, so get ready to type quickly. Who stated this? If I was running $1 million today, or $10 million for that matter, I'd be fully invested. Anyone who says that size does not hurt investment performance is selling. I'm going to jump here a little. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee it. Who stated that? I bet you got the answer. It's Warren Buffett. Warren Buffett stated this in a Business Week article titled The Homespun Wisdom from the Oracle of Omaha, July 5th, 1999. And I, for one, am not going to argue with him. In this course, we have numerous quotes from other investing legends like Fidelity's Peter Lynch, all implying and supporting Revelation 15, that small individual investors and traders have numerous and significant advantages over large ones, and successfully they use it to their advantage. There's a reason that so many mutual fund managers can't outperform, but we don't have those limitations. This is a core belief of AAII, and the advantages are covered, and how to exploit those advantages are covered extensively in the course. So Shane does this by leveraging his smaller size to his advantage. After making large purchases with his 2% deposited into his brokerage firm, he took advantage of one of the plethora of 0% credit card offers that were available at that time. He opened the new 0% card and then transferred the balance from the 2% card to the 0% card. And at that time, there was so much competition to attract the debt for those who didn't pay off their debt. They had no discipline. There were no transfer fees, and the offers were extended for 12 and 18 months periods. With this approach, Shane still got his 2% award in his investment account, but he took the money that he would have used to pay, and he transferred that to the 0% card, and then he floated that money buying 6-month and 1-year CDs that were paying over 5% at the time. When the CD expired, he took the principal, paid off the 0% card, and enjoyed a 7% risk-free return on his purchases. In truth, he did more than that. He kept transferring the balance to more 0% card. It was a simple approach, but he took advantage of a system that was clearly looking to take advantage of him. And then he did other things to get his returns into double digits. Here's a slide again showing the importance of a few more percentage points of return. Now, these techniques, as well as many other ways to generate money, assuming out of thin air, if somebody's already using credit cards, are covered in a lot more detail in the course. I mean, I just spent about 25 minutes on this, and the story with Shane literally goes for over 2 hours in the course. There's a lot of good meat there. Section 2, building a wealth building evolution. Before we get to our final revelation for our story with Shane, and I think you already know what it's going to be, we're going to look at 3 general areas or lessons that repeatedly surface from the various instructors in the EI course for improving investment performance. And again, this is a star-studded lineup of instructors. Unfortunately, some of these areas are not as popular as the other revelations, but they're also the ones that get us those precious few extra percentage points of return. Quiz question. What asset class has been ranked #1 8 times in the 11-year period from 2013 to 2023? You can win a class for this one. Type it in. And it's probably going to be number one again this year. Okay, I'm assuming you guys already got this, right? Here's the answer. It's Bitcoin. Look at right there, Bitcoin's in black. Always near the top, and when it's not, unfortunately, it's near the bottom. It's reported now that more than 20% of Americans have some form of crypto. That means there's more crypto owners than dog owners. Don't tell my dog Evie that, right? And it's estimated that over 50% of investors have some. Now, 8 of 11 years is impressive, but what is disappointing is that a lower percentage of older or so-called experienced and astute and expert traders and investors didn't participate as much as the younger investors did. So how do we use this, and what was the theme here? The first theme was that good investors and traders are open to new opportunities, concepts, and ideas, and that they evolve with the market. This is something I lecture on all the time. We know that our markets are constantly changing for some of the reasons displayed in this slide. And it creates a lot of opportunities for smaller individual investors to exploit. But on the flip side, and there's always a flip side, some investors who are reluctant to evolve try to use the same techniques, investment vehicles, and tools that were developed 40 or 50 years ago, pullbacks to a 20-period moving average. Okay, there's better ways to make money here, right? And we can show that quantitatively through back testing. In this video, you'll see me placing moving orders to purchase 50 shares of gold, the ETF. And you can see me right here doing this. Here's the bids, here's the ask. But what do you notice? That every time I'm moving my bid, the market is reacting. Do you see how that's happening? This goes on for literally 7 minutes. And I recorded this in a quieter time, so this became more relevant and more obvious. So why am I showing you this? To illustrate how our markets have changed and how front running and order manipulations are becoming a real problem for investors and a critical problem for traders. And if you question this, ask yourself how brokerage firms are making money with no commission trades, right? They're still making money, but just doing so in a different manner through order flow sales looking to front run and capture the spread. And the spread, I think you know what that is, the difference between the bid and ask. Now, you may say, Ray, the spread's only 9 cents here. On 100 shares, it's only $9. But it makes a difference. And you know I was going to do this, right? Let's go with 5 cents. And this is not a quiz. How much do you think saving only 5 cents on a buy execution on 200 shares of a stock would improve your financial situation down the road? For this example, we'll say only 35 years out at an 11% annual return. Somebody 35 in the middle of their investing and trading years for the retirement at age 70. What do we think? How much? 5 cents on 200 shares. Well, the answer is you'd have an additional $375 for every $10 gain. That's 5 cents on 200 shares on an entry or an exit transaction with these parameters due to compounding. $750 on each trade or round trip 35 years out at an 11% projected future return. Think about that. We are talking hundreds of thousands of dollars over the average stock investor's lifetime. I've done well over 40,000 trades in my day. I mean, it really starts to add up. Let's look at this another way from a dividend investor's perspective. In the EI course, we have an entire class on dividend investing. And we show that 40% of the total return from stocks in the S&P 500 comes from dividends. That's 4,000 trades. That's great. 40% on the S&P 500 is due to dividends. And we also show that over 45-year time period, dividend growers outperform non-dividend paying stocks by 4.3% a year. Good again. At times, dividend paying stocks is a sound approach. But it may not be if you're not adapting to the market, right? Let's say a stock is trading at $10 with a 20-cent spread. That is a wide spread. Let's say you used a market order, and I'm sure you wouldn't, but let's say you were foolish enough to, and you got a midfield value, we'll say, right here at $10. Well, in that case, a dividend investor would theoretically be giving up 2% on the buy and sell, by not using proper order execution techniques. Here, an investor could theoretically be giving up the entire dividend yield just to execute. The point here is that you should never use a market order, and you should learn when, the day and time of day, to and not place orders, which types of orders to use, and at what prices and which qualifiers. It's an important aspect to investing and critical for traders. And these are all covered in the course in the orders and execution class. One order type that I'm going to mention here today, just to kind of whet your appetite, is bracket orders. Essentially, all brokerage firms now have them, but they don't really push them for obvious reasons, right? Their profits, because you'd be using limit orders. And because of this, many investors and some traders, which is surprising to me, don't even know about them. With a bracket order, you're going to put your profit target and your stop loss in at the same time on a stock or ETF position on something that's been established. An example would be, I purchased a stock at $100 and I want to take a portion of profits, we'll say at 120. Or I want to get out if prices fall below 92. With a bracket order, you'll decide if you want to place protection in order to reduce your downside risk, or grab some profit if you get a big move up, and you can have both simultaneously. And you can layer these and put in multiple profit targets or stops. And when one side's filled, the other side just automatically gets canceled, and there's no additional cost for these. Now, I know what some of you may be saying. The next one that I want to go to here, I'm going to skip this section, is about complacency. Successful investors are never complacent, and they're always looking for ways to reduce risk or improve in performance. Or better phrased with a proverb, success breeds complacency, but then complacency can then breed failure. In the next few slides, I'm going to show you some ways that traders can improve returns. I've talked about this in every MetaStock webinar I've done, right? I can show you extremely convincing data that is obvious about investors and traders who use indicators that were literally developed 40 and 50 years ago when we were using pencils and paper. Here's one example of an indicator that still is a good functioning indicator, okay? But in this case, you might want to consider adjusting the methodology to the way it was first proposed 30 and 40 years ago. And you want to adapt it to today's market environment. So here's some results what you're looking for here. I just want to show you what you're looking at a 13-year study on every stock in the S&P 500 on the relative strength index, okay? And the market was a flat across this 13-year period. And we got some good results here. First of all, notice the RSI at the 2080 and 3070 levels both made money when the S&P's index's return was 0. Interestingly, on both testing samples, we got some surprising results. And that selling as soon as RSI entered the overbought areas produced better results. And this is contrary to conventional wisdom of letting that momentum run. It implied that once levels got to such a high level, don't be greedy. Well, how does that tie into a market evolution? Well, I would propose to you, because markets now turn so much quicker, and when they start to pull back, RSI is just taking too long to figure it out. So what this proposes is buy on the cross through the up 2030 level, but once it gets to that extreme, consider taking some profits off. Don't wait for the turn, because usually by the time RSI generates the signal, it's kind of too late. So the takeaway here is RSI was effective, and it was certainly more effective at the 2080 level, which is definite with all types of indicators of this nature. The more extreme readings and the rebounds, the better they end up being. But selling was different. We need to evolve our approaches with the market. Here is a new evolved indicator that synergizes different factors, and that will be available in MetaStock very shortly, called R reversion. This indicator is a variation of Bollinger Bands, which measures the volatility of an issue and plots standard deviation bands around price. It's a good indicator. This indicator, again, R reversion, does something similar, but it incorporates the intensity of the move along with the volatility. It combines two factors. So if there's a very high intensity move, it expands the boundaries out further. In a scenario where a value investor is looking to accumulate shares at lower prices on a security exhibiting high relative intensity on downward price action, our reversion will say, push them bands out further. There's too much conviction here. Similarly, let's say you're in a position that's winning and you're looking, our reversion will move the bands out further. The market's going up, it's going up in big segments, but on major conviction, push the bands out further. And if it's low conviction, then that would make sense. Yeah, the market's going up, but it's not really going up with a lot of conviction. Pull that band in and give me my sell signal. Well, that's the theory, right? But how do we know if it works? We tested it. In this table shows the comparative results with various performance metrics between R reversion, Bollinger Bands, stochastics, and RSI. Using each indicator's most common buy-sell signal with their standard parameters on every stock in the S&P 500 at that time of study over a 10-year period from 2014 through 2023. With our reversion, you simply bought when price touched the lower band and sold when price touched the upper band. It was that simple and there was no ambiguity. And as you can see right here, if it's green, it improved essentially all the common performance metrics, hit rates, profit factors, run-ups, and drawdowns. You can see it right here. Average per day returns improved by more than 20% as compared to all these indicators, all supporting the position that you have to evolve with the market. Don't get stuck in old approaches. Our third lesson from the course for improving investment performance: adjusting asset allocations to the current market environment, call it market timing if you will, can be advantageous for the disciplined, educated investor. And this could be something as simply shifting allocations to or from CDs. I think most investors would agree, even the ones that are totally against market timing, that it probably didn't make a whole lot of sense to be holding one-year CD rates from 2011 through 2017 when they were paying under 0.5%, right? Investment timing. Certainly as traders, we know this. Because most people at Metastock and traders are already trading, I cut this entire section out. I'll just jump to the ending here. I do want to let you know that AAII is planning on coming out very shortly with a new area called active investing and trading. This area will be more for hands-on investors, and we're hoping that Metastock is going to be a major contributor to this area. It's for investors who are interested in investing in multiple areas: stocks, bonds, ETFs, cryptos, commodities, the VIX, and using a variety of techniques like hedging and technical timing models, spreads, and various option strategies like covered calls and cash secured puts. We're really excited about this, and it's a new shift for us. Our final section, and the section's actually only about 4 minutes long, we're going to recap the main themes in the presentation. I'm going to give you the final revelation. I'm going to provide you the information for the free offers. I'm going to announce today's Whiz Quiz winners, or Jeffiz, for any class free in the VS library. And then if we want, we maybe take 1 or 2 questions. For most people, investing is a necessary and realistic option to achieve true financial freedom. To be a successful investor or trader, you must not only have knowledge, but current knowledge. What worked yesterday is really the most efficient approach for today. Successful investors acknowledge that our markets are constantly evolving, and they evolve with them, and they look to take advantage of and exploit new opportunities by using their investment knowledge. Successful investors and traders also realize that small increases in returns and refinement due to compounding can make a dramatic difference in their overall performance over a lifetime. I use this trading strategy and I hold it for 6 bars. Why 6 bars? Oh, I don't know, I just do it. Fine tune it, test it, see if you can get a Gaussian distribution, find out the exact numbers. Small amounts will make a huge difference, right? Smart traders and investors know how to create a plan that's right for them. They have the discipline to follow that plan, and they focus on risk, controlling what they can and accepting what they can't. And as shown, investing knowledge is one of the foundational elements to be successful. But there are 2 others. First, it's critical to not only attain the knowledge, but applying it and then taking action. And as I told you, I would end with a quote, put much more eloquently from one of the smartest men to ever live, Leonardo da Vinci. Knowing is not enough. We must apply. Willing is not enough. We must do. And this leads us to our final revelation, Revelation 16, that building of wealth through investing and trading is possible for the individual. Without the belief, people won't even try. Note the quote from Henry Ford. Those who believe they can do something and those who believe they can't are usually both right. To be a successful investor and trader is not necessarily take a special skill set or sophisticated strategies, lots of money, or a lot of expensive equipment or complicated software. Metastock is great, but it does take knowledge to develop sound modern investing approaches with a plan or a set of strategies that's right for them, that they understand, and that works in today's market environment, and that they can prove that works. And that's what the EI course focuses on. Evidence-backed strategies that can be used by all types of investors and traders with all types of investments and trading vehicles and with a variety of approaches. For this, AAII has put together some really nice offers. Everyone in attendance can get the Building Wealth Through Investing class for free. That was the focus of today's presentation by going to the website you see here on the screen, www.aai.com/VES education. That's not right. It's the one right there, www.aai.com/affiliate/metastock/Holiday.
I posted the right one in the link. No worries.
Thanks. On the same slide, we also have a link for those who want to take advantage of the EI course partnership rate holiday offer that we have, and you can get certified and obtain all the EI course certification benefits right away. And again, there's you can also, if you take advantage of that, we are going to give one of your friends or family members the EI course for free. This is a great holiday gift, and it's a gift that can make a real difference in someone's life, especially if you have children and grandchildren. And although maybe they're going to prefer that trip to Aruba or that jet ski, just tell them that you're going to give them that gift right after they attain EI course certification by completing the course. I actually had a friend of mine do this with their daughter, and their daughter took 2.5 weeks to complete the course. The power of motivation. Here's the details. If you purchase the EI course by December 9th, there is a deadline. Simply email or call AAII customer service. Provide them with the name and email address of the gift recipient. Around December 20th, both of you will receive an email from AAII notifying them of the gift and that you sent it to them. 2 things to keep in mind. The offer ends December 9th at 11:59 p.m. And number 2, this would seem obvious, once the gift offer has been sent, you're no longer eligible for the 60-day money-back guarantee. And we do give you a 60-day money-back guarantee with the course. This gives you still a few weeks to work with the course and get refunded if you want to, but you won't. It's a great course. If you want to learn more about the EI course before deciding, you can go to this website, www.aai.com/learn. We have more than a dozen documents and videos about the course. You can see the entire itinerary, all the course features, the certification process, and all the benefits that you're going to receive. My sincerest hope is that you learned something in this presentation that will help you improve your investment and trading performance, and more importantly, propel you to keep learning and expanding your investment knowledge. As there are few things in life that can bring so much potential benefit to someone that requires so little effort. Because I know it's a little corny, right? But the most important investment one can make is really investing in themselves and investing in Metastock, of course. My name is Raymond Rondeau. I'm an investment strategist and senior technical analyst with AAII, and I want to thank you for your time. And I really have done over 200 live academic, professional, and retail events, and it's still odd to me to do a webinar and not have even a token of applause at the end of this, because all I see on my screen is me looking back at me. Jeff, I'm all done. I'll hand it over to you. Oh, thank you.
I just thought I'd announce the winners real quick. We've got the things in there. So for the first question, the answer was 53,137. The answer for that one came from Neil off of YouTube. And so I think I know who that is. I'll reach out to him. For slide 21, the 12 million, the answer was George. And then slide 50, the answer being Warren Buffett, was also from GoToWebinar. Sean won that prize.
Okay.
And you may or may not believe this, but on your last answer, nobody guessed best Bitcoin. Not one answer for Bitcoin.
Really?
Yeah.
I am shocked. Okay. I'm shocked at that one. Okay.
Neil does have a question. I'm going to throw it at you and just see if you've got an answer. How much more time does it take to get to 14% in smaller stocks than 11% in larger stocks?
To get to like $1 million threshold, is that what he means?
Well, I think it was the studies that you stated where it was 14% for smaller stocks versus 11% in larger stocks. I think they were over the same time period.
Yeah, that's right. Exactly. They were exactly over the same time period. Yes.
And that was, do you remember what that time period was over?
It was the statistics that we used for that was a 90+ year time period. I think it was from like the 1930s. I don't have the slide in front of me. It came from Paul Merriman's data, but it was 90+ years.
That's reminiscent of what I saw in there. And that's a per annum return, right? That's a per year.
Yep, exactly. Okay. That's what it averaged over, yes.
Cool. All right.
And that's a big difference, 14.4 to 11, but you got more volatility, if you can stomach it.
He clarified, does it take more time and effort to find the right small stocks?
Oh, that's an interesting one.
That's a better question, yeah.
What I would propose to you is this. I think my personal opinion on this is I think it's nearly impossible to invest in the large cap area and really outperform the market by any amount, certainly as an investor, because there's just so many people there. I would say it's much easier to do that in a smaller cap area, because that's where you can find the opportunities. And we have to remember, when you're large, you can't even go down into that pool, into the really small area, because you're just too big. You'll affect your prices.
All right. Those are the winners. Those are the questions. Ray, thanks for spending some time with us. If you are watching this on YouTube, make sure to like, subscribe. It helps a great deal. We appreciate it. Ray, I'm sure I'll talk to you before then, and it seems a little premature, but have a happy holiday season.
Absolutely, my friend. Same to you, everybody who attended, and of course, everybody at Metastock. Have a great night.
Thank you, Ray.